Your money this week. Andrew and I are back together again after a hiatus. Last week, the markets were closed on Friday for 4th of July. Today, we're going to talk a little bit about how markets performed in the first 6 months of the year, where valuations are, where earnings expectations are, what that could foretell for the market for the rest of the year, plus some changes in the fixed income market that we think people should know about. But first, let's kick it off. How was your fourth?
It was great, man. It was good. We had my two sisters who live in Tennessee, one in Chattanooga, one in Knoxville, came down with their families. So a busy weekend. We always go to the 4th of July parade at Marietta Square, which is a lot of people say the grandest event of them all. So we went to that, then hung out, ate a lot of hot dogs, watched the hot dog eating contest, watched fireworks. You know,
What's your favorite
classic.
kind of hot dog? You have a
I don't
brand
know.
that you care about?
Oh no, I'm pretty agnostic. A
All right.
cooked one, I would say.
Nice. All right. That's good.
Yeah.
That's very
If it's
discerning.
grilled, I'm in. Yeah.
I
You have a
um
favorite?
I do not. I guess ballpark. Janine really likes ballpark, so I've just gotten used to those. But
Yeah.
Fenway Franks can't also be beat. I got this the Mills Police Department in town.
Ooh,
I got friends on the force. I'm not a customer or anything, but they put
look
these
at you.
badges together for 250 and I grabbed a couple of them because I think they look awesome.
That's sick.
The problem is I don't know where to put the patch. Like it's not
Right.
like I've got a motorcycle jacket or a leather
It's
jacket, jean jacket. It's like they're on my
it's a
desk for
pretty
now.
good size too.
Yeah, I got two if anybody wants the other one, but I thought they were unbelievable and now I just realized I don't have a place to put them.
I like it. I like it.
So the most serious thing we'll talk about today, are fireworks overrated?
So here's what I would say, but I love the first 10 minutes of fireworks. I
Yeah.
would say more so than overrated, they're overextended. It goes on too long. It's always late. I mean, I have two kids. My two sisters have, I think it's 812 children between them. Um, it's seven. But when you're with all those people, we always go to the same spot. We go up. There's a parking deck that you can get to the top of very easily. I drive, bring the coolers, take the coolers out, put the kids in the back of the truck, watch fireworks at the top. You can see multiple shows.
Yep.
But about 10 minutes in, I'm like, all right, let's start packing it up. And they were very extended this year. They went pretty hard. I mean, it was great, but also after 10 minutes, you've seen it. You've seen
Yeah.
it all. There's not a ton of innovation or variety.
No, Janine and I went to a pretty great show over the water and it was, yeah, 20 minutes in. And I'm thinking, I think we could have done the 8 minute version here
Yeah.
and, skipped all the small stuff at the start. But
And it's late. Like you been like we were outside all day. Everyone's tired. Everyone's grumpy. It's like let's just get out of here. But
I think we're getting old. I'm older,
yeah,
but I think you're catching up.
yeah.
All right, so let's get to the meat of the conversation on the investment side. I'm going to share this slide with you and our listeners. But the first 6 months in the market, this chart, first great half of the year, the S&P up 10%, the Russell 2000, which are small cap stocks, up 21%. Emerging markets up 24 and developed international basically up 9.8%. So a great first half despite the headlines. And that's with a pullback in stocks that accelerated, I would say, during the Iran war when it started. That was 9% of a downturn for the S&P, just to use an example of one index. So it's a reminder of what we talked about. The average year, the stock market, when it is up 18% around, right? So for an up year, for the S&P to be on pace for 20% isn't unusual. What's nice, I guess, to see is that it's not just the S&P 500. Small cap stocks, emerging markets doing much better, developed international doing well. You had answered the frequently asked question that we get in prior episodes of why were stocks doing so well despite what seemed to be a lot of bad news in the first 6 months of the year with I'm wondering why they aren't doing better. Is this what you had in mind?
Yeah, yeah, it is. I mean, I think when you think of underlying earnings performance, I think we've gotten in a really quick, rapid cycle of focusing on very specific trends or themes or headlines, whether it's the war, whether it's chip stocks, whether it's whatever. And the reality is, all those things are meaningful. All of them are impactful for certain parts of the market. They're incredibly positive or incredibly negative. But holistically speaking, earnings have been great. And we're heading into a period in which I do think the bar is higher. A lot of the comps in the first half of the year were relative to really heightened uncertainty going back in 2025. If you think of the second quarter, what was going on there in terms of tariffs last year and what that was going to look like. There was so much uncertainty. Guidance was not real robust from companies. Companies were delaying capex. Companies were delaying projections on all kinds of things. We're getting to a point where we're going to be comping over those really heightened uncertain periods. So I think the bar is going to get more difficult to clear on the earnings side, but thus far it's been great.
Yeah, which we'll get to in a second. Before we do, I did want to show you another chart on valuation. So this is from JP Morgan's Guide to the Market, which is a wonderful resource they have available. And it's a chart of valuations. So the S&P 500 is over here on the right. The forward PE ratio right now is 20.4%. The 20-year average, 20.4 times earnings. The 20-year average is 16.4. So the S&P 500 is expensive relative to its history. And then you look at the sector breakdown, so the different sectors here across the top, and you look at the forward PE ratios. Most of them are around that 20% number and higher than their long-term average, with the exception, I would say, of energy looking cheap, and then industrials, consumer discretionary, and tech look quite expensive.
Yeah, I would agree. And I think the thing for people to adjust with it, I'd be curious. I'll throw a question to you, Sammy. How much weight do you currently, like in today's world, do you put into the 20-year trailing, PE or the average PE? Because I'll let you answer, then I'll give my opinion.
I don't think it's so earnings are not really that relevant in the short term in terms of market performance, right? And um, people use various valuation metrics compared to long-term averages to scream that the market's expensive, all the while the market has kept climbing and climbing and climbing. I would say some of those arguments I've heard for most of my career that the long-term valuation metrics aren't useful. But I would say if you're looking at 20-year averages right now, you're back to 2006. This isn't like you're comparing to the 70s or 80s and gap earnings changes and, goodwill adjustments and all this stuff that people talk about when they compare stocks 40, 50 years ago. I would say they're somewhat relevant. Going back 20 years, they tell you something about where long-term returns are going to be, but I would say they're dramatically overused in the short term, and they can cause people to make investment decisions that are too bearish, basically.
Yeah. Yeah. And I think for me, I think they're way overemphasized, historically speaking, because the reality is if you were valuing a company solely on a multiple of earnings, you're looking forward to future earnings. You're expecting this earnings trend to continue or to accelerate or to do something. Otherwise, you would not pay more than one times earnings,
Right.
right?
Yep.
And so you're expecting it to go forward. And I just think back, the largest company in the S&P 500 in 2006 was ExxonMobil. Do we think ExxonMobil or in 2006 or NVIDIA has a more likely chance of having elevated earnings moving forward? I think we would all say NVIDIA, just given what we've seen from them. And I use that may sound like an isolated example in terms of growth, but those were the two biggest companies at those respective time periods in the S&P 500, and they have entirely different growth profiles. They should not be trading at the same multiple. But if you look back at 2006, the second largest company was Microsoft, obviously still a major force in today's economy. But do you know what the third largest market cap company in the S&P 500 was in 2006? Even like the industry or the sector.
Financial services.
Financial services of Citigroup.
Yeah.
And you look at where we are in today's environment, and the third largest is Alphabet. Those two companies should not trade at similar multiples.
No, but does that, the flip side of that is the financial sector became such a huge portion of the S&P, and in hindsight, those earnings, were not going to continue. They did not continue.
Yep.
Can you say the same thing basically about the most expensive stocks today, that their price for perfection. They should not be that big. At some point, they will trip up, and you should be rotating into cheaper areas of the market.
At some point that will happen, but the revenue train coming to these companies, I don't see that stopping in the short term. They will certainly misstep. Some of them maybe arguably have misstepped, and we've certainly seen the market beat them up for that so far this year, at least in sentiment and reaction. But I just think, and I get into kind of the same discussion when you compare the multiples across different economies. The reality is high growth companies trade at higher multiples. If you're an economy based on financial services or textiles or whatever, yeah, your country should trade at a lower PE. I just think the economy's changed so much. I don't put a ton of stock into the historical average.
Okay, so I did want to focus more on earnings. Since we've already kind of gotten there, let's just jump into it. Um, this is another slide from that JP Morgan deck, and it's looking at the S&P 500 this year, so 2026 year to date, source of returns. And the primary drivers of return this year almost entirely has been earnings, right? And a tiny sliver with dividends. And then multiples being negative, that means that there's been multiple contraction this year versus multiple expansion. And what that simply means is people being willing to pay more for a dollar of earnings. You would see, if that was the case, you would see the gray up here. If people are paying less, you would see it down here. And so for the last 15 years prior to this, there had been multiple expansion in the S&P and global markets. And when people see too much of that, they think maybe it's froth driving stocks upwards, versus an earnings story. Well, this year it's been all earnings, which gets me to this. We're in a market driven by strong earnings growth. And this week I saw that according to FactSet and Bloomberg data, and basically without boring everyone with the numbers, Q2 earnings expectations are massive. They're the highest they've been since we've come out of COVID. You mentioned the comps to 2025 with a lot of uncertainty there. And so, with much about investing being deviation from expectations, and this question I think gets us so much more into than just stocks since it's the economy as well. Are you worried that earnings expectations are too lofty?
I'm not worried about earnings expectations specifically. I would say that in Q1, by various metrics, and I don't have a single one, but I use this anecdotally. The frequency with which I walked through our break room where Bloomberg TV was on, and they talked about the record number of companies beating earnings expectation in Q1. It was happening almost daily as they were
Yep.
updating and rolling through earnings seasons. I don't know that earnings expectations are too high. I think there are a lot of people, how I think earnings will largely be met by these companies, but I think people are clamoring for a beat and a raise in the sense that, hey, we beat our guidance that we offered, and now we're going to raise our guidance. And I don't know that we're in a period in which we're going to get that. So I would not be surprised to see what's the outcome of that in lieu of what we've been discussing. I would not be shocked if we saw further earnings contraction in which the bar is set at an 8 out of 10. That seems very lofty. We actually came in at an 8.5, but the market was looking for us to raise guidance to an 11, and we raised it to a 9.
Got it.
So I would not be surprised to see that, and the outcome would be earnings contraction on the broad market valuation. If you were concerned about the data point you just shared, for instance, about the collective price to forward earnings. If you're concerned about it now, you should have been much more concerned in December, in January, in February. I think that will remain true once we get
Because the
through this.
market's gotten actually a little bit cheaper this year.
Yeah, I
Yeah.
think that will remain true coming out of this. I don't think we're going to move in lockstep with earnings, but I think earnings will be good. So I'm
Yeah.
not worried about earnings. I'm worried about the reaction to guidance.
Okay. Yeah. So, and guidance being, hey, we beat this quarter as an example, but next quarter, next year, whatever, it's not going to be as strong, or it's going to be strong, but the market will interpret it as a little bit of a wet blanket because it's
Yeah.
not as robust or lofty in their statements, basically.
Yeah.
Yeah.
Yeah, exactly. And I think you see a little bit
And
of a
why
snap.
do you worry about that, Andrew?
I worry about it just simply on security pricing. It's not going to be real favorable for returns. If you like 10% every 6 months, that's not necessarily a recipe for it. I
No.
use this illustration often. I think I've maybe shared it here. But when you think about both earnings expectation and guidance expectation, I always think it's a slippery slope to say, well, I'm really less focused on what I expect them to do and more focused on what they expect that they're going to do next. That's a
Right.
harder degree to pull off.
Yeah, I gotcha. I would be worried if I wasn't invested correctly. I mean, most of the time, the right asset allocation will get you through market volatility, right? So if the
Mhm.
market is too expensive or expectations are too lofty and we hit some choppiness, the right asset allocation will get you through it. The wrong one is going to get you burned. And right now, I do feel like there's some do-it-yourself investor complacency or
Yeah,
overconfidence right now. Like the market's on a tear. It's been that way for a while. Everything you own looks like it's doing good, which means you really know what you're doing as an investor. But at the end of the day, your portfolio is likely scattered across different accounts, so you likely don't have a great view of what you own,
everything.
what your overall asset allocation is, what your performance was relative to benchmarks, how diversified or concentrated you are. Because again, stocks have been running, and I know that I've been doing this for 25 years, and I'm not picking on do-it-yourselfers. I've seen the complacency and the overconfidence more from investment professionals
Yes,
than individuals over the years. So I just
100%.
know it filters down, right?
Yeah.
Um,
Real quick, here's a quick example, just because it basically came out today of what I'm talking about on the guidance. Delta reported earnings. The expectation was for $1.51 in earnings. They came in at $1.56.
okay.
They reiterated their guidance, saying, "Hey, we still think we're going to hit what we thought we were going to hit, thanks to, in no small part, a 14% expected increase in revenue." I think anyone would assume that a company as large as Delta having a 14% increase in revenue is a generally good thing, but it didn't change their guidance. Stock's down about 1.5%.
Hmm. Good. I hate the airlines.
Yeah, yeah, we don't own that, by the way. So
Um, all right. So if I just and that's a great example. So if you want to retire, just to finish my thought, in the next 5, 10 years, and you're 16 years into a secular bull plus 3 years into this cyclical one, make sure you know what you own and it's set up correctly. That would be my biggest concern about this market right now is investor overconfidence and their portfolios being out of whack from where they need it to be if they expect to live off of it in the short term.
yep, I,
Um,
I, I agree.
well, I appreciate that.
Yeah, for
You're always a,
once we agree.
you're always a very agreeable gentleman. So I do want to have you touch on fixed income because you've brought this up before. Um, so the yield curve right now versus 6 months ago, yields are higher. You look at the 10-year, which we talked a lot about, 4.4 um, versus maybe 4.1, 4.2 to start the year. Um, and then the other thing is, besides being paid more for owning fixed income in this environment, what would happen using, different scenarios of interest rate hikes or falls, to your fixed income. So using 10-year treasury as an example, a 1% rise in rates, which hurts bond prices, you're looking at a negative 3.5% return. A 1% fall, you're looking at 12.4% return. And if it's flat, obviously you get the yield at 4.4. So I would say the cost benefit analysis of owning some duration is in your favor as an investor with these higher yields, particularly if you expect yields to top out to near where they are or even, decrease a little bit from here.
Yeah, yeah, I would completely agree. I think it's certainly a time to extend some duration if you don't have it in your portfolio. We've had pockets of this. Frankly, when the war resolved and things started to calm down, well, I say resolved, obviously that's not what happened, but when the war seemed like it
You
was
said you didn't want to
resolving,
talk about the war.
I know, here I am. But there was a window, and it felt a little bit like, hey, there's still opportunities on the long bond, but that really juicy window seems to have closed. We hit basically an all-time high on the 30-year yesterday in terms of the yield that you can pick up on it. There's also an element I would encourage people to separate themselves a little bit from being so focused on returns. And if you hear nothing, I actually think this is financial advice. I know we're not in the business of giving financial advice on a podcast. If you can lock in 5% at essentially a risk-free rate for 30 years, just do it, man. Just do it.
All right.
That's a pretty sweet. return profile? And will you have some volatility if rates move? Yes. Take
Yeah,
your 5%. Take your
we
5%. That's a huge win. To your point, if you're depending on your portfolio is currently constructed to get you through retirement because you assume stocks are only going to go up, okay, that's a poor assumption to make. I'm real comfortable saying, hey, you're not going to really regret getting 5% risk free
not
for
for the
30
whole
years.
portfolio. You're just talking about
Right,
for a
right.
portion of your fixed income.
Yeah, for a
Yeah,
holding. I mean,
yeah.
nibble some there. So I think that's an attractive opportunity.
I would agree that the fixed income market has become more attractive based on yields, and I think we've talked about in the past rebalancing a little bit into fixed income if your stocks have run too much and your asset allocation is out of whack. And the chart that we reviewed shows there is an interesting cost benefit thing going on right now with different rising or falling rate scenarios. Um, so we have one more thing to get into. I'm gonna have you entertain the folks for a minute while I do a costume change, and I'll be right back.
All right, here we go. Yeah, I think I know where Sammy's going with this. Sammy's had a tough week, a really tough week. If you follow Sammy on Twitter, you've seen him very active. He and I haven't even communicated on this, but he is my official beat writer covering the beat writers of the Boston sports scene. Um, Getting sassy there, not happy about the Jaylen Brown thing.
Yes, this is my alternate Jaylen Brown jersey. I didn't know you were saw me on Twitter. That is probably
I
the
love it.
angriest. That is the
I
angriest
I
version
was
of
like,
me
man,
you could
Sammy
find.
is
Yeah,
Sammy is fired up.
there was a lot of stupidity, including with this trade. And Jaylen Brown is another thing we have in common. Marietta's own Jaylen
Yes,
Brown. So I
yeah,
am
from my
actually
hometown.
I'm apologizing to you and the town of Marietta for how we treated JB, the Boston advisor expressing a direct apology. This trade is a debacle. It is one of the dumbest things
It's
I have
so
seen.
wild.
It's one of the dumbest things I have seen a smart franchise do. And you get into all of the explanations and all of the talk and everybody who's analyzed it. You can't find anybody except the guy who pulled the trigger and the owner who's basically the face of a private equity group, looks terrified in front of the cameras to think it was a good idea. You have two guys who have won a title. They are in their prime. They play well together. And you're going to strip it down for a 36-year-old who you would have had to get a draft pick back just to take on his contract. So you basically got one draft pick for a guy who makes basically what Jaylen Brown makes. He's 36 years
Arguably the
old.
worst contract in the NBA.
According to Bill Simmons and the Ringer crew, he is in the top 1, 2 of the worst contracts in the NBA every year. You get that back. And why? Because you're worried about the salary cap in the future. You think you're going to find another guy like Jaylen Brown to pair with Jason Tatum. They don't just come out of nowhere. And um, and if there was an issue with Jaylen Brown, or you thought they couldn't coexist after Brown was, you have the supposed coach of the year, who by the way I think is a complete bozo. That's your job. You basically
Figure it out.
figure it out with these guys, and you bring them back. You don't send them out for 30 cents on the dollar. I
It
think the
seems
fan
like this should have been a dinner intervention.
that was also what Bill Simmons suggested. I would just say, do your jobs.
Yeah.
Ownership group, GM, coach. You have a
Was Jaylen
guy.
Brown that unhappy? Because I was not aware of that.
I think the great thing about Boston sports is whenever we get rid of somebody, you hear like
Oh, I
everything
know.
afterwards. Like, and
I mean, the mental gymnastics of like, I mean, this guy was sixth in MVP voting. He's got a Finals MVP, and they're talking about him like he's like a really unhappy number three guy.
yeah,
I'm like,
and then
what are we talking? Like, this guy's a superstar.
you get all these analytics and nonsensical arguments. But here's an analytic: you traded for one of the worst contracts in the NBA, and you got very little in return for a guy who basically carried a team of okay NBA players to 53 whatever wins they had last year in the number 2 seed. Idiotic trade. I apologize to Marietta. JB, we got your back, buddy. But
Do I
yeah,
need to
sad
pull up
day.
my favorite Jaylen Brown tweet?
You can do that. Yeah.
Give me one moment.
Well, and the other thing is we have a power listener who's a big Sixers fan. So on Sunday afternoon
Yeah,
when he listens to this, I just want him to know um, I'm not happy. I invited him to come to a game, and what I'm basically going to do is not show up.
yeah. So Jaylen Brown, like for further context, like he's from the town I live in. He went to Wheeler High School. Wheeler, I played at McEachern High School. They're kind of the two powerhouse program. A lot of people say Jaylen Brown's the best high school player from Cobb County, Georgia, since I graduated. That's not to say that I was the previous best, but factually, I think that would be correct. But on April 28th, 2014, Jaylen Brown, still a high school student, tweeted out. Now, this is at 1:56 p.m., so presumably still during school hours. My teacher said she would look me up in the Cobb County Jail in 5 years. Wow.
Yeah, I remember that. He does talk about that. Yeah. I mean, he has a chip on his shoulder, and I think he should have. And he's just a phenomenal competitor, and these guys work well together. And good luck trying to find another one
Yep.
like Jaylen Brown to pair with Tatum and build out another championship roster. Because guess what? You had it, and you
Yep.
just blew it. And Paul George, good luck to you.
And
Because
I hate to say it, but I might be a Sixers fan now.
well, that just seems unnecessary.
I just got to follow Jaylen.
Is that because when I was being recruited to be a Bama or Georgia fan, I gave
Yeah,
very
you went
little
the other way.
attention to Georgia?
You
Yeah.
went the other way.
I just don't like the dog. It just
You're
seems
you're
really weird.
you're often on the wrong side of history on these things.
Don't you guys play in like some of your games in a turf dome and like I don't know, it just doesn't seem reasonable to
Yeah,
me at all.
it's well, we do that like for SEC championships.
Oh, right, every few years when
Yeah.
you're in that. Gotcha.
Every year, every year. I mean, I do follow Jalen's career pretty closely, and I was just absolutely shocked by it. Um, it's crazy.
It's crazy. And that press conference, they looked rattled. It was completely inconsistent from what they said at the end of season press conference. Good luck to them. I tried to get refunded on my season tickets.
Really,
Yeah, I that didn't go very far. So anyway, I will be there and we'll see how it goes. But
you got to get a Paul George jersey now.
I can guarantee almost nothing in my career because of my industry and compliance. I can guarantee you I will never buy a Paul George jersey.
Oh, well, that's good choice of words. You will never buy one. I might buy one for you.
Oh God. All right, this is done. Have a great weekend, buddy.
See you, man.